So with parts of the market at a record, what is next for stocks? Joining us to discuss this is Brian Levitt. He is Senior Director of Investment Strategy at Invesco. Welcome, Brian. Nice to have you here tonight.
Thank you. Nice to be back.
And you make the point that we are still in a long-term bull market. There's more to go. Why do you feel that way?
Yeah, I mean, investors need to get used to the fact that this is a slow growth world without a lot of inflation. So what that means is even though this cycle's been going on for a long time, we haven't built a lot of excesses in the economy. We're not seeing the inflation that brings forward Fed interest rate hikes. And it's very rare for cycles to end without a series of interest rate hikes. The reason why the markets have been responding the way they have in recent days is because the Fed's backed down off their tightening stance. And you know, with valuations where they are and the global economy okay, this could go on a lot longer than people suspect.
And in fact, you are among those who feel the Fed will cut rates maybe a couple times this year before the end of the year. And I'm curious, you know, Fed Chair Jerome Powell reminded everybody yesterday of the Fed's dual mandate of maximum employment and stable prices. What is it that's calling for a rate cut right now, do you think?
What's calling for a rate hike right now is that inflation. A rate cut is inflation expectations have fallen meaningfully in the United States and around the world. And so, you know, if you think through the last number of years, Fed tried to raise rates in 2015. Well, they did. They had to back off of it. They did it multiple times in 2018, slowed the economy, and now they have to back off of it. So every time the Fed tries to step in with a different policy stance, i.e. tighter policy, the markets react, yields go down, borrowing costs go up, the economy slows, markets go down, and the Fed backs off again. And so this is no different than what we saw in early 2016, and you know, the Fed's rightfully doing it. Inflation expectations are simply too low in the United States.
We do have some headline risk, though, do we not? We have an upcoming G20 summit. We don't have a trade deal with China. And now we have renewed tensions with Iran.
Well, we always have headline risk. I mean, if we're going to wait till there's absolute certainty to invest, we'll never invest. You're right. The trade policy is disconcerting. And, you know, the big risk with trade is that it'll lead to a flight to quality, strengthen the U.S. dollar, and slow down the U.S. economy again. So that is a risk. But the reality is what that means is the Federal Reserve is going to lower interest rates and stay easier for longer. So, you know, 3 years ago, investors would have been talking about Brexit. What did Brexit mean? Brexit meant easier policy around the world and markets that continue to go higher. So if we get a bad outcome between the U.S. and China, that's not good from a macro perspective. But what's more important is what does it mean for investors? I suspect you may have a bout of volatility around it, but the Fed will respond and markets should likely go higher.
On that note, Brian, thanks so much. Brian Levitt with Invesco.
Thank you.